Hi, Nathan from Buyers Club here. Recently, Domain released a brand new set of house price predictions for the year ahead, and it reveals some really interesting forecasts about where the market might be heading. These are the figures, as you can see, pretty consistent with what we've seen lately from other forecasts, like from Westpac, which we covered in a recent video. In terms of detached houses, Domain again expect Sydney, Melbourne, and Canberra to decline over the next year. But they expect Brisbane, Adelaide, and Perth to slow a little from recent momentum, but still continue growing steadily. So, on that front, at least, nothing all that exciting compared to what we've seen lately. What's interesting though is that Domain have included a unit forecast here, and as you can see, they're expecting units to outperform houses in almost every market listed. For Sydney and Melbourne, they expect units to be largely stable, even as house prices come down. In Adelaide, they expect units to match house price growth at 6% in the next year. And then in Brisbane and Perth, they expect units to outperform house prices by 2 percentage points over the next year. And this really reflects a lot of what's being discussed post budget about the emergence of units as a more popular investment strategy. Already, we've seen affordability play a big role in dictating where property prices actually have room to grow. So now, with the removal of negative gearing, the appeal of units as a class of property really seems to be building. And so, to that end, we've put together some research lately, taking a look at the case for investing in units over houses at the moment to try and better understand both what kind of an investor this strategy might suit, and then also which locations might be prioritized for looking at unit investments. And the outcome of that research was that units in Melbourne really seem to have some unique value at the moment compared to some of the other major capitals. And in this video, I'll take you through a few of the highlights from that research, but the report is also up on our website if you'd like to have a read through it in more detail. So, to highlight a few charts from the paper that support this thesis, this first chart shows how house prices have tracked since mid 2022, split by market tier. So the red line shows us the growth of the top 25% most expensive property markets around the country. The blue is the cheapest 25%, and then the black is the middle 50% of markets by price point. And it's clear just how big of a role affordability has played in terms of price growth recently. Since late 2022, the cheapest property markets around the country have clearly grown more rapidly than the rest of the market. You can see the lower priced markets in the blue here. And at times, the gap in price growth has been as much as 5% between the cheapest and the most expensive markets, particularly if you look around mid 2023 or even more recently, mid 2025, the gap was quite large again. So this just goes to show that even pre-budget, this was a clear theme shaping the market. Buyers have already been so constrained by affordability that the lower end of the market has had so much more room to grow. Now then, post-budget, it stands to reason that this trend is only going to intensify without negative gearing there for investors. We've seen plenty of discussion about borrowing capacity being significantly cut for investors without negative gearing. Some figures have it at about a 20% drop in borrowing capacity post budget for new investors. So, units then, often being so much cheaper, seem to really be poised to benefit from this further concentration of demand that's looking for increasingly cheaper investment options. And that lower price point has some secondary advantages too: higher yields and potentially some greater flexibility for diversification across multiple markets rather than buying just a single house in a single market. Secondly, if we take a look at the relationship between houses and units, units do really appear to be undervalued at the moment relative to house prices around the country. So, as it says on the screen, this chart is tracking how many times more expensive the median house is compared to the median unit over time, expressed as a price multiple. You can see that back in 2010, the median house in Australia was just under 1.4 times the price of an average unit. And that figure has been rising steadily over time through to today, where the multiple is up at about 1.65. And that's really a substantial margin above where it has been historically. Before 2021, the average house to unit multiple was down at around 1.45. So this really suggests one of two explanations. Either it could be that houses have become permanently more valuable compared to units than they have historically been in the past, or this trend could indicate that houses are currently a little bit inflated relative to units and that we're due for a correction through some catch up growth across unit markets that will stabilize this multiple and bring it back down toward the long term average. So that's a quick summary of a couple of the big themes shaping the emergence of units, which looks interesting, but this, of course, also begs the question, if units really are emerging as a good option, where should investors be looking to buy them? And that brings me to this next chart, which is comparing unit data across the major capital cities. And as I said earlier, when you look at unit markets through these lenses of affordability and relative premium compared to houses, Melbourne seems to be a real standout. Melbourne is actually the cheapest of all these cities for units, with a median price of $585,000. And it also has the second highest house to unit price multiple at 1.49. Sydney is obviously way out in front with a multiple of 1.85, but a median unit there is now also $815,000, which will definitely be out of reach for many investors. And I would say will cap just how much growth is possible across units in Sydney. So looking more closely at Melbourne then, we did some further research into which unit markets within Melbourne itself seem to be strong, both in terms of that relationship with local house prices, but also in terms of more fundamental property market metrics, taking into account things like yield, days on market, and stock levels, among others. And some of the results were quite surprising. I won't run through the full list in this video, but again, if you'd like to see our results on that in more detail, please head over to the website and check out the full report for the complete list of unit markets in Melbourne. That's just a quick summary, though, of some of our thoughts regarding units at the market. Please let us know your thoughts, though. Do you see units as a strong emerging option? Historically, they've obviously been the less popular option after houses, but has the budget changed your thinking at all on that? Please leave us a comment and we'll see you in the next video. Thanks.